the point is that liquidity is no longer ample. We don't know where it is on the scale. The Fed doesn't know. So, I think to your original question is yes, there's still stress in the market. There are a lot more Fed tools that kind of limit the stress, put a floor and ceiling on some of that stress. So it's not maybe as concerning as it would have been in 2019. But nonetheless, there's liquidity issues, and the Fed will be doing some variation of QE. How that plays out, I don't think anyone knows, including the Fed at this point, but that is coming because there is a liquidity shortfall.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap, this time featuring my good friend, the buffeted portfolio manager, Michael Lebowitz. Mike, how you doing?
I'm doing well, Adam. How about you?
I'm doing well. Folks, we got Michael this week because this is one of the weeks that Lance is taking his wife to her chemotherapy treatments. And we're wishing them very well. I think they're past the midpoint on this, so hopefully they're starting to feel like they're in the home stretch. So that would be great. Michael, I picked the word buffeted for a couple of reasons. One, out here in my new home in Nevada, we are having a pretty decent rain and windstorm. So my house is getting pretty buffeted by the winds. The market similarly is getting pretty buffeted today. So we'll talk about that, I'm sure. And then lastly, Warren Buffett, a great investor, just announced that we won't be hearing from him much anymore. He's going to be quote unquote going silent. Understandable. The guy is what, in his mid 90s at this point in time. He's already handed over the reins to the CEO there at Berkshire Hathaway. So I just want to mark that milestone.
So lots of buffeting today.
Lots of buffeting today. So why don't we go straight to the market buffeting? So markets have seemed to sort of switch quickly into risk off here, and you can walk us through anything you like. This is Friday. We're recording this earlier in the day, as we usually do on Fridays. So the market hasn't closed yet, and who knows what'll happen between now and the close. It does seem to be off the lows a bit, but today's, so far at least, been kind of a rough day unless you owned the VIX or oil.
So apparently, Adam, you haven't looked. We are now flat on a day.
Really?
The market has done a U-turn. They have bought the dip. The more conservative stocks that were doing much better yesterday are down today. The high-flying tech stocks are up today. So quite the reversal, quite the unbuffeting over the last, I don't know. I looked at it right before I got on with you, and I was kind of surprised as well. So,
Wow. Yes, I think I looked at it about 30 minutes ago before I started working on my list
well,
here. So that's
well,
been pretty pronounced recovery.
yeah, as you know, 30 minutes in this market is different, can be a whole different ball game.
Wow.
You
Okay.
know,
Well, then let's walk through this then, because one of the questions I was going to ask you was, are we seeing any important trend breaks here in the market? And maybe we were, but maybe they're unbroken at this point now.
right. So with that, let me, I created a few graphs. It's probably easiest to show it. What we have here is the S&P, the SPY, the S&P 500 ETF. And, Lance and myself have been talking ad nauseum about the MACD, which has been slowly declining in the face of the rising stock market, and very similar action in the RSI at the bottom of the graph, negative divergence. And, that tends to be a bearish signal. And we've been paying close attention to it. As you can see, I circled up at the top. We hit a high back in a few weeks ago. Market sold off, came back, but it didn't go back to the higher high. It hit a lower high, and now it's selling off again. So what we want to see today by Friday's close is whether we stay above that prior low or close above it. We don't really want to see a lower low, especially for the week. I then drew a dotted line in there too. That, even if we set a lower low, we'd like to stay above that dotted line, meaning that the market is potentially just working off, consolidating and working off some of this overboughtness. Those are some things we're looking at. And to your question, the moving averages, you have your 20, 50, and 200, red, blue, and black. Where who knows where we are now? Unfortunately I did this about an hour ago, so it's off. But we should probably be right above or right on the probably right above the 50-day moving average. And that's kind of the key one. That's the one that's provided support since April.
Okay, and Michael,
The
is it the blue one here?
yes, the blue one. The reddish one is the 20, and you can see it's been support, but we trade through it. It's not, the pinpoint support. The 50 days been more of a more reliable level of support. And clearly, if we convincingly break the 50, we break that dotted line. The next big step is the 200-day average, which is that black line, which is quite a ways to go. So, that's another 8% or so lower. But the thing to note is the MACD has come down. That's the one on the top, right? But it's still at a relatively high level. So it can certainly come down a lot more. The RSI is slightly below 50. 50 is fair value. So it's not oversold. It's just back to fair value. So there's something in these charts for the bulls and the bears. If we hold support and today's rally, today we end up green and maybe those tech names lead the way today. The trends of the prior few months are back intact, or we just consolidate for a while before we get back on a bullish track. But again, if we start breaking some of those levels, we have to pay more attention and think about our risk posture. One of the things that concerns me is kind of what's going on. The speculative stocks have led the stock market, and speculative assets have kind of led this environment of speculation. So what I have here are call it the three horsemen of the speculative trade, for lack of a better word. The orange is gold. The bar chart is IBIT, which is the Bitcoin ETF. It was easier to chart that than Bitcoin, but they're virtually identical. And then that called teal line is an ETF called MGK, and it's the mega cap stocks. So it closely resembles the Mag 7. So, and I drew a circle at their peaks. You can see Bitcoin peaked before the other two speculative markets, fell off, rallied, but set a lower high, and it's gone down, and it's not looking great here for Bitcoin. You don't see the moving averages, but it's below its 200-day moving average. It's trading sloppy. Gold peaked a little bit after that. Similar behavior. It fell. It started rallying back, and we're still at that point now where we don't know if it's going to rally back to new highs and keep going or set a lower high. So that's to be determined. And same with MGK, which is representative of the stock market. We peaked. Are we going to start setting lower lows and lower highs? But given that the focus of the market has been on kind of these three asset classes, gold, Bitcoin, and high-flying stocks, for lack of a better word, these are the ones to watch to help assess where the broader markets are going to go. I'm sure you and Lance have talked about it a lot, the breadth of the market. The breadth of the market has been horrendous. It's been one or two sectors and 10, 15 stocks leading the way while a good handful of stocks are lower. So what I want to do is kind of show how breadth is changing a little bit. Now, again, maybe it's just a corrective action. We're going to see when the market sells off, you're going to see those sectors, the conservative sectors, the ones out of favor, do better than the high-flying sectors, which, control the S&P 500. There's 7 stocks that make up 40% or so of the S&P 500. So some of it is just math. And what we have here, this is from SimpleVisor, and what it does is it shows the sector relative performance. So how did it do versus the S&P 500? And I set it up to look at the last 10 days, the 90 days before that, the 90 days before those 90 days, and so on. And goes out to October 24. And what I highlighted here with that red box is healthcare, because that's kind of been the star of the last 2 weeks. It beat the S&P by 6.72%. And you can see technology, when I did this, was down almost 3% versus the S&P. There's a little bit of a rotation. So the question is, that call it 8, 9% rotation between technology and healthcare. Is that it? Are we good now? Is breadth good? And to answer that, you really have to look back in time. In the short run, maybe. In the long run, sectors like healthcare, like staples, like energy are still grossly out of whack from the broader market. You could see healthcare lost 5% over the 90 days before that, 8%, 11%, while technology was zooming ahead, beating it by 10, beating it by 4, beating it by 1%. So in the short run, we may, this rotation may take a little break. And if we hit new highs, probably technology is going to lead the way. But if we continue to see sectors like staples, like healthcare, like energy continue to outperform, that probably means that those tech stocks are heading lower, which you could have a weird market where the market's down, the S&P 500 is down, the NASDAQ is down, but there's a good handful of stocks that are up. And we think that's one of the most important parts of investing is rotation. I clipped this from our daily commentary. These are two screenshots, 2 weeks apart. The one on the right is I think it was from yesterday. The one on the left is about 2 weeks ago. And we look at a series of stock factors and we assess using technicals, are they overbought? Are they oversold? And we do it on both an absolute basis and a relative basis. So just using technicals on the price of whatever ETF represents the stock factor and doing technical analysis on the ratio of that ETF to the S&P 500. And we can create this grid you see on the right side and put each factor in there. And without focusing on which factor is where, what you can see is that scatter plot is very scattered. There's stuff in the top right, there's stuff in the bottom left, it's all over the place. If you look over to the right, you can see they're starting to compact a little bit. The ones that are oversold are kind of moving back towards the overbought quadrant, and vice versa. The ones that are overbought were kind of moving back to the middle. So, another indicator there that breadth is getting better. And I just made this for you, Adam. Why do we care? Right. The question is, why do we care about breadth, about rotations? And again, I think it is so important. So what I did was I just took staples and technology, and I look at their excess returns since October, about 2 years, right?
And that's just to give a sense of sort of highly speculative versus very defensive, right?
Yes. And you can do it for all different factors, sectors, whatever you could do 2 stocks. And this again is excess returns. So if you had technology, you beat the S&P by call it 11, 12%. And if you had staples, you underperformed by 30%. So again, it's not measuring what staples did, it's how did staples do versus the S&P 500. So if you look at these, they're not mirror opposites, but they're very close to opposites, right? When one's going down, one's going up, and vice versa. So what that's telling you is that there are times when staples are outperforming the market, underperforming the market, and at those same times when staples are underperforming, technology is probably outperforming, and vice versa. So you can hold the S&P 500, or you can spend some time and pick the sectors that will be beating the S&P 500 and avoiding some of the sectors that will be underperforming. So this this combination has a correlation you can see on the bottom right of an R squared of about 0.70. That's pretty tight. And what this just looks at the data slightly differently. Each dot is the daily change in the excess returns. So you can see this bottom right quadrant is when Staples daily returns are higher. And then if you look to your left, corresponds with technology daily excess returns being lower, and vice versa. So it's kind of telling you the same thing you see up here, but it's a much more cleaner statistical way of looking at it. And, like I said, this has an R squared of 70. Some of the factors that we look at have R squareds over 90. So if you look at that graph at the top left, they're virtually almost mirror images. So again, if you're following rotations and you have the tools, which we do offer on SimpleVisor, to tell you when one is overbought and when one's oversold and likely to change, the ability to chart the ratios against each other, a whole bunch of other tools, you can better take advantage of the market. So that's why Lance and I talk about rotations a lot, because it's a key part of money management. And managing risk is not just about buying, it's not just about your exposure. How much exposure do you have to the stock market? It's also about, what does that exposure look like? Is it conservative? Is it aggressive? Is it oversold? Is it overbought? Even in 2000, there were plenty of sectors or factors that small cap value did extremely well, while the market in general really got hit hard. So, the point is, there are various ways to hide. And some of those ways of hiding from a market that you think is really going to come down is just in different sectors or factors, in addition to adjusting your exposure. So, I because breadth has been making headlines, I think the rotations that we've seen have been very pronounced over the last 4 or 5 months, and it provides the opportunity to really show what rotations are, how they have actually played out, and how to take advantage of them.
Okay. And so, Mike, let me just sort of repeat this back to you to make sure I'm clear and the audience is clear on how you guys are using this. So, let's say we're looking at one of your factor quadrants there, and technology is way up to the right, meaning it's looking pretty overbought, right? So sort of like that chart right there. Yep.
Right.
Now go back to the chart you were just on, which basically says, hey, we see there's a pretty pronounced inverse correlation between technology and staples. So, we think at some point this overbought nature of technology isn't going to be able to sustain forever. So while they're kind of on discount, let's put some of the portfolio in these staples, so that when technology kind of mean reverts and starts becoming, less overbought, we can ride. We should be able to ride. We should be able to avoid some of that, and we should be able to ride some of the appreciation in the staples, which should appreciate as those technology stocks cool off. Am I capturing it correctly?
Bingo. And what you find is, when stocks are in a very upper right corner, or sectors and factors are in either corner, they don't stay there for very long, and they tend to gravitate towards the middle. So in the process of gravitating towards the middle, if you're in the bottom left corner, it means your technicals are improving, which usually corresponds with a better stock price, and vice versa for the one in the top right corner. So when this was taken, there was some, so you, like, mid cap value was just very oversold. That's the one in the top. And the bottom one is, I got to look around here, it was mega cap growth. So those are your basically your Magnificent Seven, was very overbought at the time. This was 2 weeks ago. That trade would have done decent over the last 2 weeks. Mega cap stocks have led the way down, and small cap value has done a little better. Before doing a trade like that, though, I would look at what their correlation is. Is there a correlation? So can you draw charts like these and show an R squared of 0.70? or is the R squared very small and their relationship isn't meaningful. So likely if I did gold miners, which were also a week or two ago in the top right corner, and staples in the bottom left, these charts would not tell me. It could be a great trade, but these charts are not going to tell me that statistically, if they revert the odds, it's not going to, the odds are in your favor.
Yeah.
Um, so and sometime when we get a chance, we could go through Simple Visor. I could show you how one of the reasons, we put the tools up on Simple Visor to help our subscribers use it, but we also do it for ourselves. All of these things are in spreadsheets. We're in spreadsheets, and it's really sloppy to share it, to share spreadsheets with God only knows how many tabs are in each spreadsheet and they're updating, and it's sloppy. So for us, this is a godsend to go to a website, our own website in this case, and just see things real time.
Yeah, no, Supervisor's amazing, and Lance does a pretty good job of walking through it in real time. But yeah, Michael, anytime you want to come on and walk through any particular elements of it, I know the audience would be really interested in that.
Right.
Back to these charts for a second. So, Lance has very often said that trend lines act like gravity. So, when things start getting really overbought or oversold, it's sort of the rubber band effect, right? Where
Right.
stretched rubber band, gravity eventually pulls it back more towards, its equilibrium state. So that's sort of what you're playing here. And coming into this year, I think both of you and Lance wrote about how you expected more volatility in 2025 than we had seen in 2024, 2023, which is totally proven to be the case. And in that type of market, I would imagine this approach pays off more, right? Because you get more opportunities, you get more distortions, more times the band is stretched, and more ability to play the reequilibration. Has it proven to be that type of year for you? Do you feel it's in this kind of, it makes a case that, hey, in a year where just everything goes up, yeah, passive investors do just fine. But in a year where there's more volatility, the active investor has a chance to make superior returns. Have you been seeing that this year?
Yes and no. So the year started off, I think I was using the word roller coaster when we were talking in December and January. I expect the year to be a roller coaster. We go up, we go down, we go up, we go down, we get nauseous, and we end up where we started, right? We went up, we went down in April, and then we've been on a nice steady incline since then. So there haven't been that many significant rotation trades. And you can see it in that graph I showed with staples and technology. Other than from like January to April when staples outperformed technology, technology's just been going up and versus the S&P
Yeah.
and staples down. So it's presented itself a couple times. Even now, they're not significant enough that had you done that trade, it would have been nice, but not significant. So, I would characterize this year more as trending. If we look at from April to today, we're trending. We're starting to get some jitters here, some volatility. But like I started with, we haven't broken really any key trend lines. There's nothing here that tells us we're going back down, that we've kind of coming over the top of the roller coaster. Time to buckle up. So, if that is where we're at and we're starting to go back down the roller coaster, then yeah, absolutely. You should be looking at these rotations because I think being in staples, financials, healthcare, a few other sectors, types of stocks, stocks too. You can't just, you can buy the staples ETF or you can look at the stocks within the staples ETF and pick among those as well to even clarify this analysis further. So, the point is that if we are turning, you should figure out how to use some of these rotations to protect, but you can stay invested instead of just getting out and potentially missing whatever the market may have.
Right, right. And one of the things that Lance is always really harping on is while you're still in the market, right? And he would say it's relatively rare you get signals that it's like an all out, like just move to cash and just, he's said many, many times, those are real tail risks. Those moments are real tail risks. And what you don't want to do is get shaken out prematurely, to your point, and then the market recovers, and then you've missed the rebound, and now you're stuck in cash, and you're trying to figure out when to get back into the market, and oftentimes, people just sit immobile there, and the market keeps going up, right? So, he's talked a lot about investing in a way so that you are. When you see some warning signs, like you just walked us through a few with the potentially higher highs and maybe some of these assets starting to make lower highs, is look at some of these more undervalued parts of the market that would potentially, either have less froth in them. So if the
Right.
market goes down, they'll go down less, hopefully, or the capital will rotate. It'll rotate out of the super popular stuff that's gotten frothy into these less loved categories, and you may actually make some money, right? So, he mentions those strategies in saying, hey, it's great to match the market. If the market's having an up year and you guys try to do your best to do that, but no guarantees. And part of it's because you're deploying some of these other strategies that risk manage the portfolio, right? That give you more downside protection. He's always saying, look, it's good to catch as much of the upside as you can, but it's far better to catch less of the downside, right?
Right.
And mitigating that downside risk is really how you get superior long-term performance. So I just want to make sure that a lot of what you're talking about here too is just a way to stay in the market, but with less risk.
It's risk management, right? Again, we've talked about you can sell stock, you can just sell stocks. That's one way to manage risk. You could buy puts. That's another way to manage risk. A third way to manage risk is just to change what's in your portfolio. Sell your Nvidia and buy Procter Gamble. That's going to mitigate risk. So, there's plenty of ways to mitigate risk, and we use all the above. And like anything, the more tools you have, the better your chance of success, whatever success may mean for you. So that's why this is one of our tools, especially in a market that we don't really know is definitely heading lower, right? If we were 100% certain it was heading lower, that would change our strategy. It's showing some signs of topping. It could easily keep going, right? We're entering the very positive seasonal part of the year. Santa Claus is coming to town, and he always brings a rally with him.
Right.
Stocks are,
And
companies are buying
we're
back
back
their
for most
stocks.
stocks. They're now back in the buyback window where companies can start buying back their shares. And it's funny, I want to connect a bunch of dots here over the next couple of minutes. But to your point, like 2 hours ago, this conversation was going to be all about, how are we protecting ourselves from these falling prices if the market's, going to continue going down from here. But to your observation earlier, I'm looking, the S&P is now up, 40 basis points here. So it's now an up day, for the markets here. The Nasdaq's up almost 1%. A lot of these guys that were down 5, 6, 7% are now, they've cut those losses in half. We'll see where things end up here. But to your point is, it's kind of a market that's keeping everybody on their toes here, right? For those that are looking for signs of weakness and cracks, there are definitely some there, and we're going to talk about some in just a moment. But the market also, is showing a lot of resilience, and it's not that far off all-time highs. And here's one question I wanted to ask you, Michael, which is, it's such an interesting market because it increasingly seems to have only two states, which is nothing stops this train. This market's just going, perpetually higher, or oh my God, the world is ending. And I just want to pull up the fear greed meter here. I know you guys have a slightly different calculation that you use at Real Investment Advice, but you'll see here, we're in extreme fear. Right? And this number is a little bit higher than it was about an hour ago when I checked it earlier this morning, but we're still in extreme fear. Now we are less than 200 basis points off of, or 200 S&P points off the S&P all-time high, right? That's 2%. And yet that's been enough to make everybody just freak out like the world is ending here. So we seem to have this, strong market, right? It's been resilient all year. It's gone up to, it's made a number of all-time highs. It's still close to its all-time high, but it's almost like on a knife edge, right? Just a little bit of wind in one direction or the other. All of a sudden, everybody's really worried the whole house of cards going to come down. What does that tell you about this market?
Well, I think most people understand that valuations are very high. And again, I'm not just talking about companies like Palantir or the CoreWeave or NVIDIA or the big tech names who actually some of them their valuations are actually not too bad. The bigger ones, the Googles, Microsoft, even NVIDIA. But if you look at the staples, if you look at some of those other sectors that we call conservative, they are very overvalued too, right? The Cape on the whole S&P 500 is 40. The highest it's ever been was 44, I believe, in 99. In 1929, it hit 27 or 28. So, you know, it's extreme. I think the market knows it knows it's extreme. It thinks to some degree it's playing with fire, but when you're at highs, there's always a narrative that takes the other side of that argument and that says, yeah, valuations are extreme, but that's because we're pricing in all this future economic growth due to AI.
Right.
And
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 quote, it's different this time.
and that's the kind of devil and angel on your shoulders, right? One of them is telling you, oh, this is so overvalued, this isn't going to end well, and the other one's saying it's not overvalued. Look at everything compared to growth rates, and these are good deals.
And
Like,
if it's a bubble, we're still in 97 and there's years of great gains ahead of us.
or we're in 94, right? Not even necessarily in the bottom, towards the end of the baseball game. So one of the things like you should really focus on is price to the PEG ratio, price to earnings to growth. Price to earnings doesn't tell you much. I mean, it tells you the price of the stock compared to the last 4 quarters. But what about the next 4 quarters? You're buying a stock for the next 4 quarters, 8 quarters, 5 years, 10 years. That's what you really want to know. And in most cases, companies have a somewhat steady earnings trend. So if you are looking at the last four, that's a good approximation for the first four. And that's why PE ratios and other price to sales, other kind of traditional valuations work. But if you look at some of this AI technology and the massive capex being spent and the massive potential, it's a different story. You're looking at growth rates that are potentially explosive.
Yeah.
So
Can
there's
I,
two
sorry to
sides
interrupt you,
to
but
the argument.
let me just ask this question because it's going into the next big section I want to talk about, which is this a head fake boom? In other words, it's a bunch of capital spending, right? So it's companies saying, look, I gotta buy all this infrastructure to play in the new world order. But at some point, the infrastructure will be bought. So, a good question is just how realistic are these growth rates? Yeah, they're explosive right now because people just are throwing money hand and fist at buying, chips and data centers and stuff like that. But, once you got enough, you got enough. So, are we faultily extrapolating this growth further out in the future than we should be?
Possibly. I think to me the maybe the bigger risk is that whatever they're buying today will be bad in 2 years, in 3 years.
Yeah.
If
I'm
you go
going there
back
in
to
just a moment too.
if you go back to the 1990s, it was the fiber optic. They were just spending a massive amounts of money laying fiber optic across the country, and still use fiber optic. It's still valuable. But
It's just as good 10 years later than it is the day it's laid. Yeah.
these chips that they're developing could be outdated in 6 months or a year or 2 years. There's AI is proving very beneficial for these companies, but it's also giving all their competitors a new way to think about all this stuff and to create an even better product, whatever, whether the product's a data center or a chip or whatever it may be. So we may look back on this and said, NVIDIA did a great job with those Model Ts, but but it turns out that AMD is the one that really got this whole thing rolling, or some other chip company. And they created this chip that doesn't need these big, you don't need these massive data centers. You can put it all in a shed. And, it just changes everything. So, that's the problem with investing in cutting edge technology like this is that you don't know what the lifespan is of these investments. They may not be over investing, they may be over investing into the wrong things.
Wrong thing.
And
So to
that's
me,
what we'll find out.
that's a double danger here, right? So even with fiber optic cables or even with the railroads, right? We overbought initially because everybody didn't know how high was, and so they had to go find it, right? Hey, the
Mhm.
transformative new technology, I want to get in on this, I want to be one of the winners. You just overbuy, and then you realize, oh my gosh, okay, we've got all this overcapacity, there's a big washout, and then over time, the survivors and the new companies build off of all that excess capacity. So you can make an argument that that's likely to happen here too, no matter how long-lived these data centers and chips are. But then you're also saying, okay, well, even if we go through that traditional cycle, there's also the potential risk that this stuff doesn't age well in the ground the way that fiber optic cable or railroad ties did, where this stuff is just largely kind of useless after a couple of years, right? So we've got two really big concerns there. And hey, how's it going to play out? I don't know, but I think those are valid concerns to be raising. So okay, here's the section that I want to talk about. So we've got this market that is very richly valued, right? Such that, as I said, it's sort of on this knife edge of, a little bit of unwanted wind in either direction, and all of a sudden, everybody gets worried that the whole thing's going to come down. So we're starting to see. I think we've seen a turn in the media, literally, I think over the past week or two, where seem to be all of a sudden a lot more doubts about AI getting thrown around than there had been. And I've seen articles recently about the amount of funding that they think it's going to take to do the build out as currently envisioned. And they're just saying, like, I don't know if the capital's there. Okay, I really don't know, like, if we're going to be able to raise enough money to build out the infrastructure the way in which the industry is saying it needs to be built out. I think the last number I saw floating out there was something like around $5 trillion or something like that.
Right.
So that's at the ecosystem level. Then you're hearing the same thing at the company level. So like Oracle, which, caught the AI fever later in the game, right? The stock was up tremendously after its earnings call, right? A big blue chip company tacked on like another third of its market value in an hour.
No, all it did was have an arrangement with, it was either OpenAI or NVIDIA. That's all it took for that stock.
Exactly, which is nuts. I mean, that's definitely kind of a sign you see near the end of a mania, right? Where just big crazy
Mhm.
plays like that happen. But people have done the math. I think Barclays just downgraded the Oracle's debt to sell because it's basically
Mhm.
saying, look, Oracle's going to run out of money. Like if looking at what it said, it's capex investment it's going to need to make. They're like, we don't see any way that Oracle is going to be able to raise that money over time. So you're starting to see real concerns like that. But then, you're getting more voices just saying like, hey, I just don't know if all this spending is going to be worth it, right? Sure, it benefits the guys who make the chips and the guys who build the data centers, but are we really going to get enough incremental revenue and profits out of this to justify these gobs and gobs of hundreds of billions and trillions that are being spent on it? So anyways, that's still an active debate. I don't know the answer to that question. It's that the doubters or the challengers are just getting louder at this point. And then you're seeing, I think, a lot more fear creep into the market right now about like fraud and deception. So, there's obviously been a lot of ink spilled in recent weeks about the circular financing that goes on here. And I think a lot
Right.
of those questions are still open-ended. They're not fully answered yet. But you probably saw, Michael Burry and his tweets over the past week or so, where first he came back to Twitter after a long break, or X after a long break, and said, "Hey, look, I think there's a bubble." And then he appeared to sort of rage quit the markets. He'd Ben disclosed that his firm had been short Nvidia and Palantir, which obviously he must have gotten his face ripped off on those trades. And he dissolved his investment firm, which a lot of people thought was sort of admitting defeat, and who knows, maybe it was. But he just recently came back on and said, "Hey, now that I'm not like bound by um, my compliance constraints, let me really tell you what I'm worried about." And he started talking about this depreciation of or the short-lived lives of the technology here, the chips
Right.
themselves. And he said, look, these things last maybe 2, 3 years, but companies have started getting really creative with their depreciation schedules, and they've more or less kind of doubled on their books the active lives of these chips, on paper. And so what that does is it reduces their depreciation expense in any given year, so it artificially inflates their profitability. So Michael, you and I and Lance have talked many times about how with earnings, you got to take them with a grain of salt because they can be monkeyed around by all sorts of accounting tricks. But this seems to be like a pretty big accounting, I think Michael would say deception right now, that a lot of these big players, and he named Meta and one or two others, where he said, this is like, if they were counting what he believes to be correctly, it would shave like 20% or more off of their earnings, which would have a real material impact in their stock prices. So my point here, Michael, is just that we're seeing, I think, a lot of real doubt start to creep into this space, and manias are all built on sentiment, right? They end when the net buyer switches from being, a net speculator who wants to buy to a net seller who just says, you know what, this is too rich for my blood. And it feels like, I don't know where that line is, but it feels like we're getting closer and closer to it.
Absolutely. I mean, the market is finally questioning everything that's been going on. And look, no one really knows what the useful life of these chips will be. Will it be 2 years, or will these companies be right? Could it be 6 or 7 years? We don't know. History tells us it'll be shorter rather than
Yeah.
longer.
Well, I think they know right
Uh,
now from the recent history, 2, 3 years, just because of the innovation pace.
right. No, right. So, the market is finally questioning things. I was going to bring up with you, I wanted to bring up the debt issue, because if you look at kind of where the steam got taken out of the market, it was when Google and Meta brought between the two of them about 55 billion in debt deals. And to me, that was a significant point. Prior to that, the market, the AI companies were largely self-funding. So, we talk about all these circular deals. Google, Meta, Nvidia, they were investing in companies, financing companies to go and buy their chips. So they were all using cash flow to do that. They weren't using debt. All of a sudden, Google and Meta come to market with big debt deals. That's starting to tell the market that cash flows are no longer sufficient enough for some of these companies to
Mhm.
keep going, and they have to borrow. Well, when you borrow, you're introducing default risk. And like you said, Oracle, the default risk, if you look at the credit default swap markets, they've been going up decently. It's not a trivial chance they go out of business based on what's implied by the credit default swaps. Same with CoreWeave. And then the problem is they're all in this web of companies. To me, the
Right. So
riskiest
you have
one
sort of
is
counterparty risk too, to a certain extent.
right. Nvidia has counterparty risk to CoreWeave. They lose their investment if CoreWeave goes under. To me, the one that's the hardest is OpenAI. That's the nexus of this whole web. And that's where all the money has been in, just massive amounts of money is being invested, and it's a private company. So we don't know what's going on
Right. And they kind of
internally.
freaked people out recently, right, by sort of sending up that trial balloon of like, hey, and if things go badly for us, hopefully the government's going to bail us out, like trying to get a pre-bailout
Correct.
agreement, right? And everybody was
Which
like, what?
which that came out about the same time as Google and Meta when they did their deals. Right? It wasn't even bailout. It was like we could use some government support, and then they backed down.
Well, yeah, they, they,
But
they sort of, changed their tune a little bit, but yeah,
right, but they still said the same thing, but in
in
different
different words,
words
yeah.
afterwards.
Not a
So they're
bailout. We just want the
basically,
government to backstop everybody. Yeah.
well, I think what they're saying is they're questioning whether there's enough capital.
Hmm.
That's, I think, really what's going on. And Google and Meta are telling you they need more capital. All these smaller companies that keep going to Nvidia and Microsoft and Google and Meta for financing don't have the capital. So it's starting to some degree to be capital constrained. And that only gets worse when investors, debt investors, question, start why do we need why do you need so much capital? That, it prompts the question of what's going on here. And we're also liquidity is strained right now. So that's another kind of complexity to this whole debt funding scheme that's going on. So, you know, I think we're finally at the point in this AI trade, you call it a bubble, call it whatever you want, where the right questions are finally being asked. And the market is thinking about that and digesting it, and we're getting a lot of volatility. But there's nothing that's really overly upsetting, or you would really see it in the market.
So I agree with you in terms of market technicals right now, although I think we're seeing more volatility, like you said, right? So there's,
Yeah.
we're seeing signs that we should be paying more attention, but nothing yet that's saying, hey, the wheels are coming off here. But I would say the fact that the right questions are being asked puts us in a more dangerous era if
Mhm.
indeed there is an AI bubble, right? And folks can still debate that if they want, but if they are, asking the right questions finally gets you to the point where the answers might cause a sentiment shift. And a sentiment shift in sentiment is that's what's fatal to a bubble, right? So let me ask you this.
Exactly.
Let me ask you this question. So I put a post out on X last night, and I want to connect a couple of different things here, and I'm going to say something that's going to sound fairly pessimistic, and then I'm going to argue the other side in just a couple minutes. Um, but it is increasingly clear, I think, that the economy of real things, right? Not AI and software and whatever, but just, logistics where things get from point A to point B, things get manufactured and whatnot, that economy is in recessionary territory, right?
Right.
Um, and that economy employs a lot more people than the information economy. If you add up like all the Mag 7 or 10, companies, I think they employ like 2 million people versus, tens and tens of millions of people who are in the real, get your hands
Right.
dirty economy. Um, and we're seeing an increasing number of signs that, the bottom half of society is having more and more trouble getting by, right? Um, and yet, on average, things still look okay, right? And this is the difference between mean and median. And we've talked about this in the past. In fact, somebody on X summarized my argument very aptly by saying, um, uh, two guys, two steaks, you assume that both guys are eating well. But if it's one guy sitting at a table eating two steaks and the other guy looking outside through the window, or looking inside through the window, standing outside in the cold,
Right.
it's a very different story, right? And it really feels like that's the type of economy that we have right now, right? So the question so what's propping things up is all of this massive spending in the AI part of the economy, right? Um, and because that's supporting asset prices and the concentration of these top 7 or 10 stocks supports the indices and drives the industries,
Mhm.
the indices higher. Um, the people who own financial assets are doing just fine, right? And they're supporting, on average, retail spending, right? So the question is how long can that continue to sustain? And my question is, or my challenge is, you know, unless or if we don't start getting some real incremental revenue and profit growth out of companies that aren't the ones that are, making the AI infrastructure,
Mhm.
if we don't start seeing some real corporate return on investment here, the bloom is going to come off that rose. And if it does, I mean, my question to you is, how bad could things get? But I guess before I ask you that, my question to you is, you know, how sustainable is this, right? Because we're getting far enough into the AI story that I think we should be starting to see some real use cases to say, oh, okay, well, this is worth spending all this much because these companies are making gobs of new profits off of incremental new services that AI has enabled, right? And I don't feel like we're
Right.
seeing that yet.
No, you said that really well. There's 400 companies that are barely seeing their earnings grow. There's, pick a number, 70% of 80% of citizens that are struggling financially, whatever the number is. It's that K-shaped economy. And from a stock market perspective, it worked because Nvidia, Microsoft, Apple, the Mag 7 are 40%, 30, 40% of the index. So they
Yeah.
can go up and offset a lot of bad news. But as we're finding, when they run into trouble, there are issues because they can't support the market. We had plenty of days where we'd have, we have 20, 25 stocks in our equity model. 3, 4, 5 were up, the rest were down, and our portfolio would be up for the day.
Hmm.
I mean, then that's what's been going on with the market and in general, and with the economy. They're all kind of K-shaped versions of the same thing. So my concern is, I mentioned this to you earlier. If you look at price to earnings for the other companies, all the ones that aren't the Mag 7, the AI companies, they're high. They're very high. So you run the risk that the company's keeping the whole market afloat. And look, I know staples haven't been doing as well as the market, but they haven't been crashing either. They haven't been brought down to valuations that make sense, or utilities, or pick your conservative sector. Uh, so the risk is that if the AI bubble collapses, it's going to bring down other things with it. So to your point, there's nothing sustainable about it. And I think some of it gets political too. We just saw, it's tough to make too much sense of the last the elections that occurred in early November. But if Trump loses the House and Senate, that's a vote that prices are still a problem, that the economy, it's really an economic vote to some degree. There's obviously other issues that are very important to people, but it's the economy, stupid, as who was that, Bush?
That was Clinton.
After Clinton, same error. So, that's what people vote on. And I think we're starting to get this problem where the voices of the 70% of the economy, where the large majority of companies can't sustain themselves well. And that doesn't bode well for risk assets.
Yeah. So it's interesting. So you're talking right there about the sustainability of the weak side of the K. Well, I think that's a
Well,
concern. I'm actually much more concerned about the sustainability of the upper side of the K
well,
because I'd feel more sanguine about it if we were seeing lots of incremental new revenues and profits kick off of AI and just these companies were just benefiting from it all, right? Um, to me, this
so
is like
here,
this is a balance sheet transfer, right? We're taking cash flows that otherwise would have just become assets on the balance sheet, or we're raising debt and we're feeding these companies that are building the data centers and building chips, but we don't know what the return of that's going to be yet. And if we don't start to see that, if that does force a repricing of those stocks, then the top 10, 20% that's doing all the consumer spending, there's a negative wealth effect. They rein in, and then kind of, I don't want to be too, dark here, but then kind of everything goes to hell in a handbasket, right? Because then you have the weak bottom half of the K, and the top half of the K gets a lot weaker all of a sudden, and then we're really in,
right.
yeah,
So I think another way to think about this is is a K, but not necessarily. You have your upper part, and everyone thinks of a K, like what a
yep,
K looks like. What I would say is you got your upper part, and then you got the bottom one is not really like that. It's more flat. And there's ropes holding the top part onto that kind of bottom part. And when that bottom part starts slouching, it's going to go down, but it's also going to bring down that lower leg, that lower part of the K. So they're tied to each other, just like consumption is tied. It's all economically tied to each other. So
yeah.
I think I
Well,
have the
because
same
once
fear
that
as
top part of
you.
the K reins in its spending from a consumer standpoint, Well, that's when companies have to start laying everybody off, and that's when the
Right.
bottom of the half really feels terrible, right?
I think what I'm trying to say, Adam, is I kind of feel exactly the same as you, that that is a potential problem coming down the pike, that we can't continue to have an economy, a stock market driven by 10 companies and an economy driven by AI spending when everything else is flat to even negative. Shipping is a disaster. That's a great sign of what's going on in trucking. Great signs of what's going on in the economy. They're disasters. There is no more real estate market. Houses don't trade, right? The big segments of our economy are stagnant.
Are stagnating. And
Um,
I'm so glad you mentioned trucking because I've got it. This is one of the dots I wanted to connect. I've got an interview coming out, I think on Tuesday, with Craig Fuller. I've already recorded it, folks. Um, it is really scary. Craig Fuller of Freight Waves, they're, I think, like basically the leading like freight tracking company out
right.
there. And so he's got, laser granular sight into what goes on in shipping, whether it's trucks or whether it's trains or shipping or whatever, right? And he's saying, yeah, oh, we're definitely at recessionary levels here, and it doesn't look like it's going to get any better anytime soon. I will say too, just a quick side note, as scary as that part of the discussion is, it gets way scarier because we get into the huge number of uh, basically illegal immigrants that came into America over the past several years who have been able to obtain commercial driver's licenses with basically no experience at all. So when you learn about the just vast hundreds of thousands of drivers on the road driving these heavy trucks who you know paid someone to get the license, right? So they didn't even pass a test. They don't even speak English. It's super, super frightening. But back to your overall point there, Michael. Yeah, we've got these big parts of, like as I said, the economy of real things, right? That's really struggling here. So I'm not the only one thinking this way. And right before we sat down here, I saw this article that really, showed other people are thinking the same way. The title was "Why the World's Fate Hangs on 2.5 Million Older Americans." And the headline or the subheader was, "The worry isn't a recession causing a market crash, it's a market crash causing a recession." So it's basically consumer spending is being propped up by, this sort of top 20, this 10, 20% who are more affluent Americans. They tend to be older, right? So they're doing fine because their 401ks are nice and flush right now. But if all that changes, that then, that's a market correction that then changes their consumer spending behavior. That then, if they rein that in, that's then potentially what creates the next recession, and we get this sort of vicious cycle going for it. So, to your point, it just
And I would argue it's sentiment that it also, so when Trump signed the opening of the government the other night, he said something like the stock market has hit 40 something, 48 new highs this year. It's record wealth is being generated. Everyone's 401ks are at record highs. That's great for the top 10% of the people,
right.
but it doesn't apply to 90%. But I think what the reason he says that and the reason other presidents talk about the stock market is because it's the sentiment gauge. And I think even the people at the bottom end that don't own any stocks, they hear about the stock market's doing well. Oh, the economy must be fine, right? So it impacts whether you own stocks or not, everyone's sentiment. And when sentiment regarding the economy changes, consumption changes. And it takes a little bit of a downslide in consumption to have a big impact on the economy.
On the
So
economy. Yeah.
sentiment, narrative matter.
So I agree mostly with you. Where the nuance I would inject in there is, uh, so yes, sentiment among those who have wealth totally matters in terms of the direction of the economy. I almost think it doesn't matter. I hate to say this. I almost think it doesn't matter how the bottom 80% are doing if the top 20% are doing well. They can be the engine that just keeps economic growth moving and whatever. And that's not a healthy economy. I don't like it, but I'm not sure the bottom 80% matter all that much anymore
So
from a spending point. But the longer that the narrative out there, the public narrative is everything's great and everybody's 401ks are doing great, right? The As that bottom 80% gets further and further left behind, their sentiment becomes much more bitter, and then you end up getting real change at the voting booth. And I think we're already starting to see that. I think we started to see that in these most recent elections, right?
Mhm. So I would argue that that the bottom 80% matter because economics is always on the margin, right? We look at things as percentage changes. Retail sales was up 0.3% or down 0.4% or whatever it is. So the impact of the top 20 may be more, but they're more stable. They're fluctuating, let's just go to the top. Bill Gates, his spending he doesn't care what the economy's doing. He's whether, it is he going to dinner tonight? It depends if he's hungry and if he wants to meet someone. It has nothing to do with the economy. With the bottom 80%, if are they going to dinner tonight? What's the economy doing? How do I feel about spending money? I'm thinking about this is going to cost me $100. That's kind of in my head. So I think it's that 80% that tip the scales. They don't, their impact may or may not be what it is for the top 20, but they're the ones that can change retail sales growing by 2 or 3% to slipping by 2 or 3%. And in economics, those percentage changes can have a big impact on, what's a recession? When the GDP slips 3 or 4%, that's really not much, right? That's one or two tables at a restaurant not being filled. So, it's on the margin that tips the economic scales, and that's where I think those 80% do have a big role.
They may, and I don't have the chart at my fingertips here, but you've probably seen the chart that's circulating recently that shows like the top 10%. I mean, it's like 50% of all consumer spending. I mean, they punch way above their weight. The bottom 50 or 60%, I can't remember what it was. I want to say it's maybe like 15% or 17% of overall spending. Like they're marginalized in their spending amount. I also think too, a lot of that cohort is already spending on the things they need, right? So it's harder for them to drop their spending by 10% because they don't have a lot of fat to cut, right? It's
Mhm.
just stuff they're just doing to get by, right? Whereas that top 10%, yeah, they can, if they say, you know what, I'm still doing okay, but I'm going to cut my spending by 10%. I'm just a little less, I'm feeling a little less flush than I normally am. You're going to see that immediately in the consumer spending. So we don't have the data in front of us. I'm not saying you're wrong by any stretch. I'm kind of even hoping
No,
you're right. I don't like the fact that so many people are almost don't matter in the data anymore. But maybe you're right.
well, I think they all matter, right? It all matters. But I think the propensity to spend or not spend increases as you go down to the lower classes. Whereas the variability in spending at the top is irrelevant. It's based on other things other than the economy. So if you want to kind of know what the economy is doing, I think that lower, wherever I don't know where you draw the line, but when you're starting to look at that lower percentage, and they're buying more durable, more you can tell by the types of goods too, what they're buying and how it's changing. And look, by the way, we have the holidays coming up, so it'll be interesting to see what the holiday sales look like. Black Friday is only what, a week, two
Actually,
weeks
that's
away?
right. We'll know pretty soon. Yeah, again, what the latest sort of heartbeat of the health of these folks are. I'm gonna no, I don't know. I was gonna stick my neck out and take the under on the estimates, but I'm not sure I want to be that risky yet. But we'll see.
And who knows what the estimates are.
Yeah, but this is where like I don't envy your role as a capital manager, but at the same time, I appreciate it much more given this type of environment, right? Where we have this party going on in the markets, but you just don't trust it for a lot of really valid reasons, right? And it
Mhm.
seems premature to just totally get out of the party and move to cash and all that stuff. There's a lot of risks that are associated with that. But it also seems increasingly risky to be in the party too. Like it's like I said, I don't envy your position to have to bear the weight of hey, I've got my fiduciary responsibility on my clients, and that's telling me I can't be fully out, but I can't be blindly long either. So that's tough. And at the same time, this is the time where you really want to have a financial expert who is doing all the things that you mentioned, the risk management and all this stuff, to still be in, but to be doing things to hopefully save your neck in case, some of these fears that we're talking about with the AI trade actually get realized.
And look, here's the bottom line. Kind of like flying an airplane. I have a million gauges in front of me, rules, tools, all kinds of things that tells me what's going on with the plane, with the path, with what's ahead. If I was flying a plane with no instrumentation and just looking out the window, that's scary. And that's, I think most investors are kind of doing that. But when you have all these tools that we've built and experience, look, Lance and I both have 35. I have 35 years. He's what, 50 years of experience? He's at least 50 years
He's
older than
probably
me.
70. I mean, that
80.
dude's
I was
old.
going to say
Yeah.
80, but you may
Yeah.
be right. No, I mean, we probably have at least 70 plus years of experience between the two of us through, numerous crises and periods of volatilities and bubbles and boring markets and all of the above. And when you can sleep at night knowing that you have tools, that you have risk monitors that tell you that start flashing yellow or red, and that you can easily get out of the market if you want to, or get into the market, or rotate, or buy hedges, or do whatever it is you need to do. So, I'm not saying that like days like yesterday or even earlier this morning when everything, when the tech sector was bright red, don't get to me. But I'm not a nervous Nelly because I know that I have all these tools and I've weathered these storms before and will weather them again. So I think that's, what we've been seeing for the last few weeks is very different than April was a mess, but very different than the general trend of the last couple of years. And that's, again, where having tools and wherewithal makes a huge difference.
Right, and experience. And this is really where you separate the pros from the tourists, right? We talk all the time, Michael, about how it's our emotions that oftentimes are our worst enemies when
Hmm.
it comes to building wealth over time, um, because they generally force us to make the wrong decisions right at the wrong time.
Yep.
And as we're starting to get some more volatility in here, I'm definitely seeing. And I showed you the general greed fear index, but I'm starting to hear stories of individual investors saying, "Oh, I panicked out of the market, or I sold everything yesterday, or I went all in on X and it went down, and now I'm contemplating, putting my head in the oven."
Right.
So it's time like these folks where unless you do have a lot of experience as a DIY investor, you've got a good set of tools, you've got your portfolio mission statement that Lance, talks about, and all that grounding and all that experience and knowledge to really leverage. You're probably better off here saying, hey, who's a more experienced, captain of my financial ship than I, and look towards trying to find that person for you. All right,
And
I
here's
want to go
another,
ahead.
Adam, real quick, here's another thing.
Yeah,
We have a team. So it's not just Lance, it's not just me. We talk to each other all the time, and we don't always have the same opinion. Half the time we don't. Being able to talk to, and it's not just Lance and I, we have a whole team of
right.
people, many of which are our age or old people that have been through these same cycles. So it's for the individual investor, you may have all the tools in the world, but it's also helpful to just look at other opinions and be able to have a conversation with a friend or a colleague or whoever and discuss conditions because they may have a different view and that view may help you immensely, or it may cement your view. You may
Right.
say, wow, I was even more right than I thought I was.
Well, and the individual investor, I think they tend to approach investing as, okay, so what's the right best next stock, right? Or investment, what's the thing I want to buy that I think is undervalued, is going to do well or whatever, right? And that's where they place all their focus, right? So it's really on trying to assess the probability around this particular security. Whereas I'm sure you guys do that to a certain extent. But a lot of what you guys do is you have the institutionalized knowledge about portfolio construction, right? So what you bring is like, well, hey, here's a way to construct the portfolio so that if A happens or B happens or C happens or D happens, we can kind of control the outcome more than just throwing darts at a board and crossing our fingers, right? Yeah, and I
Right.
think
We
that's
got
what the
it.
average DIY investor is a lot lighter on than just the, you know, forensic skills of, oh, I think this company might be undervalued.
Right. We got the question, or I got the question a week or two ago, why do we own AbbVie and Lilly? Or probably about 3 weeks ago, 4 weeks ago. And because they were underperforming. They've been doing the best. They've been our two leading stocks through the healthcare, through what we've kind of experienced over the last week or two, because it's a diversified portfolio. And you don't want to put all your eggs in one basket. And understanding how you're diversified and what parts are doing what is incredibly important to managing money and honestly to sleeping at night. Because if we had all our money in the Magnificent Seven, I wouldn't sleep at night.
Yeah, yeah, yeah.
Though I may have retired already, so it may not be a problem.
Right, right. Well, that's the thing, you never know, right? All right. Speaking of things that we don't know, what's the latest on the credit markets? I see that the repo usage has continued to respike. Are things equilibrating, or are we still seeing signs that nervousness is growing in the credit markets?
So there is stress growing in the liquidity markets. I think my article this week actually kind of talks about what I won't go into it in detail unless you want to, but the gist of it is what changed in 2008? Why is the Fed always involved in the liquidity markets? Why is it always providing liquidity, saving the market, quote unquote? It never did that prior to 2008, or it only did it on special occasions. What changed? And, here we are again. The Fed stopped QT. Fed members are telling you they're going to be buying assets soon enough, which is QE. They're going to be providing liquidity. What's changed? The economy's doing fine. The markets are fine. It doesn't appear that anything has changed. And what this comes down to is after 2008, when the banking system literally almost collapsed, they changed a lot of rules. It used to be that so the overnight funding markets are the core of every other market. It's kind of the nexus. Without that overnight funding, without that leverage, these other markets would have massive problems. It supports all the leverage that supports all the markets. You need healthy overnight borrowing markets, lending markets. So there were a series of rules put in place after 2008 that really took those overnight markets away from private institutions and put them into the Fed's hands. Um, like Basel III rules, for instance, you've probably heard of LCRs or SLRs, leverage ratios essentially, that have changed the capital rules, that have really had a big impact on what banks can do or can't do. Uh, Proprietary trading desks. Banks can no longer trade their own books, which means they can no longer provide liquidity when it's needed. Money markets. There used to be a thing called prime money market funds that would provide a lot of money into the markets. Well, now, after one of them broke the buck because it held Lehman bonds in 2008, what we really have now are pretty much primarily government money market funds. So a lot of what's happened is the Fed has kind of handcuffed, and the regulators have handcuffed all the private suppliers of liquidity. They're the ones that have to supply liquidity now on a daily basis. And what we've seen recently is that the Fed put way too much liquidity in the market in 21, 20, 22 even. And we know that that excess liquidity is now gone. We could see it in our overnight repurchase program. That's where all that liquidity was sitting. It's now very close to zero. And sure enough, the Fed stopped QT. They reduced QT, then they stopped QT. They're talking about QE. We're seeing rates that are not kind of overnight borrowing rates that are not quite where they should be. That tells you that there's stress in the market. So the point is that liquidity is no longer ample. We don't know where it is on the scale. The Fed doesn't know. Um, but it's the Fed that manages all this. So, you know, one of the things that also kind of helps us invest is just understanding things like the liquidity situation, understanding what the Fed is talking about. Because if, I think most people were to read these Fed speeches, they'd be like, whoa, I don't even know what I just heard. Fed white papers, how all these what esoteric overnight borrowing rates, what they mean, and how they interact with each other and what they tell you. So, I think your original question is yes, there's still stress in the market. Uh, there are a lot more Fed tools that kind of limit the stress, put a floor and ceiling on some of that stress. So it's not maybe as concerning as it would have been in 2019. But nonetheless, there's liquidity issues, and the Fed will be doing some variation of QE. And by that, I just mean they'll be adding to their balance sheet, putting reserves in the system. How that plays out, I don't think anyone knows, including the Fed at this point, but that is coming because there is a liquidity shortfall.
Okay, so if the government really now is in charge of providing the liquidity that the system needs, which is pretty much what you've said, is there a reaction function now? I'm thinking of like Minority Report with pre-crime, where they arrest you before you even make the crime, right? Like, are they now much more likely to foam the runway? So to be like, look, we don't want to wait for a crack or an accident. We'll actually provide liquidity in advance if we think that things are getting a little bit wonky.
I think so. And when I was Lance and I did our podcast yesterday, and I kind of walked through the article a little bit, but I really said, look, if you don't want to read the whole thing, I get it. It's kind of wonky. At the end of the day, it doesn't matter. What you need to know is that a lot of that liquidity has been put into the Fed's hands, providing that liquidity. What really matters, though, is it's kind of a pick your poison. Who do you want managing liquidity? When the street did it, it wasn't, we had bubbles, but bubbles burst because confidence burst. Banks stopped lending money to people. Lehman goes under, things like that, things break. Now we have the Fed, and where bubbles arising and bursting were somewhat commonplace and to be expected. I'm not sure we can, not that the bubble won't deflate. I think it's a big question of how it deflates now. Can the Fed somehow get a slow leak, or will it ultimately burst anyway with or without the Fed? But to your point, I think the Fed is in a position where when JP Morgan's providing liquidity, all JP Morgan cares about is JP Morgan. Will JP Morgan get paid? How much money is JP Morgan making on this? When the Fed provides liquidity, it's what's the impact on the economy? Not our balance sheet. Will we lose or make money? They don't care. Will we be able to meet our goals of inflation and employment? Can we stop? They don't want the stock market from cracking because that can feed bad sentiment and kill the banks, hurt the economy, the whole nine yards. So we now have a provider of liquidity that's not profit and risk uh, constrained, but just focused on the economy and basically focused on keeping the bubble intact. And, it's an awful thing. That's not how free markets work. And it's very detrimental for capital allocation, productive investment, all that. But that may be the optimist story here is that the Fed will not let this AI bubble burst.
So, all right, I said earlier I was going to make an optimistic argument too. So the interview I have coming out after this one. So this one launches on Saturday. This one I'm referring to will launch the next day on Sunday. It's with Mike Green. of Simplify Asset Management. And as you probably know well, he is a big student of the market's passive capital flows, right? He
Yep.
coined that term, the giant mindless robot, to describe the just relentless buying that happens every month, in large part from corporations that have employee retirement funds that they have to get into the market, right? So no matter whether the market's up, no matter what market's down, it's just price blind. It's buying stocks. And because of the way in which it buys stocks, a, a vastly disproportionate amount of that capital goes into the top 10 stocks, right? Giving them this sort of relentless price blind bid, right? That just pushes assets higher and higher over time. And Mike has done a lot of research around this. I mean, he's released white papers and done a lot of real advanced research on this, and says his firm has, in their opinion, successfully isolated a passive factor. So you talk about the factors that you have there in SimpleVisor. They have a factor that they have calculated that is the passive factor that a security enjoys from the giant mindless robot. And kind of like you, with the Fed being this super eager backstop now, and that's the
Giant
optimist.
mindless robot.
Yeah, he's like this passive factor kind of matters more than anything else. And he's like, until the passive capital flows get compromised, he's like, I fear that nothing else will really matter. And he had a really good analogy. And if you guys can watch, if you're interested in this, you can watch the interview. You should watch the interview with Mike tomorrow. But he likened it to water, right? Like, we know the properties of water really well. We've got water in a bowl, and we can do a lot of things to it, and we have a lot of confidence as to how it's going to react, right? But he's like, you put that bowl on a stove and you start heating it up. The thing that's going to matter most is that you're adding more and more heat to this water, and that's what's going to drive its properties more than anything else, right? Mm-hmm. And if you ignore that heat, you're ignoring the most important factor that's driving what's happening to the
Right.
environment you have there. So he kind of feels that's a pretty apt analogy for the passive bid, where he's like, it's just the one that matters more than everything else. And unless you take that bowl of water off the stove, that's just what's going to drive the action here. And so, of course, it begs the question, well, how long can this continue? And his answer is, I don't know. It could end next month, or we could be old men. So again, to really hear Mike's full argument for the passive bid, what it is and what impact it has, listen to the interview. But I mean, I guess that's the optimist story. It kind of depresses me because, again, I don't think that's a fair market. I think it just creates greater and greater distortions that if and when at some point that heat source gets compromised, the collateral damage that will then ensue, as you and I were referring to earlier, is going to be really tremendous. But market didn't care what I think. It's the way the market's currently operating.
Right. And I agree. You have these two mindless force, not mindless, but well, his is mindless. Mine has a mind behind it, but it's set on one goal. These two forces that are very optimistic for asset prices. A difference is that, I've read a lot of Mike's stuff and listened to him, is that there's a demographic aspect to this passive flow. And that as people get older, they have to start selling stocks so they don't keep buying stocks. And that trend changes. Whereas I'm not sure what's going to change the Fed. And to be honest, I think it's March or May or whenever Powell leaves, you're going to have a new Fed chairman that will be even more invested to keep the stock market up.
Right. Likely even more dovish. Yeah.
Right. So, whereas my robot may even get stronger come May or March, whenever Powell leaves, there is a trajectory that's going to change in Mike's robot that will become less optimistic and becomes pessimistic if the flows actually reverse.
Oh, if the flows reverse, it's
Lights out.
It's lights out, yeah. And I get your point about the demographics, and it's funny I didn't talk to Mike about that this time. I have in the past. I will say, just given his general demeanor, he doesn't think that boomers are going to become sort of net sellers and pushing those flows into reverse. I think anytime
Right.
soon. Now there could be other factors that do make that happen sooner, but he wasn't like, oh, I see the cavalry coming and don't worry, in a year or two, it's all going to be different. So
Right.
anyway, so the point here is just look, if you're watching this, I'm going to guess the majority of people watching this probably share a lot of the same concerns that you and I have been raising through this, particularly about, what happens if the bloom comes off the AI rose and all that stuff, right? Or the problem the credit markets get bigger or whatever. But I think you have to be very careful about saying this thing's going to end in tears and it's going to end in tears soon because of reasons X, Y, or Z. You've got to have a really, really good, compelling reason why the hyper interventionary Fed isn't going to matter, or the giant mindless robot isn't going to continue to matter. Um, and and I think that even if you decide to bet against those forces, you better have some plan B in case they continue to sustain.
Well said.
Yeah.
Well
And
said.
I'm just
So
curious,
it's
we'll start wrapping up here, but what do you guys do in terms of how do you take into account the passive factor, if at all, in your capital management there at RIA?
We acknowledge it. I mean, we know it's there. And when we're thinking about what stocks to buy, we do look at which ones are at the top of so if we're looking at staples, we may have a little more interest in the largest staple than the 20th staple. Because if flows are going into staples, it's the same thing. So, we certainly factor that into our
Invest
logic.
in who's getting fed by the robot?
That's just one of many
Yeah.
factors that we think about, but it certainly is a factor.
All right.
Um,
Well, look, we'll start wrapping up here. I'll squeeze this in. We can talk more about this later on. There were two bits of news that came up on the mortgage side. So you talked about how the housing market is, basically super dysfunctional right now, which totally is. And I've talked about that a lot with a lot of housing experts on this channel. But we had recently the trial balloon floated by the administration about 50-year mortgages, which I've written about on X on why I'm totally not in support of that. I think it's a bad idea. I think the administration is sort of potentially saying, okay, well, all right, we sort of put it out there. We're getting some bad feedback. Maybe we won't do it, whatever. They're still saying, oh, it's a tool that might be in the chest going forward. But the other thing that they're now starting to talk about are portable mortgages, which I think is kind of interesting. And I haven't fully thought through it. But this is obviously, you own a house, you have a mortgage. Let's say you're someone who's lucky enough to be sitting on a 3 or sub 3% mortgage. It's been a limiter to sell your house and move right now because the new mortgage you're going to have to take out on your new house is going to be like double, right? Now you might be able to take your mortgage with you, right? That might be good because it might open up some transactions in the market, helping unfreeze it. It's kind of still not super fair, right? The people who got a great deal continue to get a great deal going forward. But if the mortgages are also assumable, where let's say I'm buying your house, Michael, and you've got a tasty low mortgage rate on it. Let's say you're now moving into you're older, you're Lance's age, and you're now moving into the nursing home, right, or the assisted living facility. Um, you might be able to sell me your house with your mortgage on it. And that would actually make it a lot more affordable for me to buy in. So I've always kind of been a fan of the assumable mortgage idea. They have been out there. They have existed prior to now. They're just
mhm.
they're few and far between, and it's kind of hard to find out who's got an assumable mortgage. And there's a lot of work that you have to do to get in there. But I'm curious, do you have strong thoughts either way on either of those two things, the 50-year mortgage or the portable slash assumable mortgage?
I think the 50-year mortgage is ridiculous. You save a few $100 on your monthly payment. You're building no equity. I went through an example, and if you compare 50-year to 30-year, in 30 years, you have 100% equity in the house. You've paid off your loan. For 50-year, at the 30-year mark, you only have about 25% equity.
Yeah.
So you're not building equity. You're saving a few bucks monthly, but over the life of the loan, you're going to pay the additional amount in interest versus a 30-year is more than the original loan amount.
Yeah, it's crazy.
So, the longer it's a spectrum. If you borrow my credit card, right? That essentially it's a 1 month loan and that's it. But when you start moving out the spectrum, it flows from just kind of a delayed purchase to a lien, to a loan, to a lease. So even though you're buying a home on a 50-year mortgage, you're essentially leasing it. You're not building equity unless the price is going up. The problem with assumable or any of the or transportable mortgages is that you can only apply it to new mortgages. You will destroy the banks if all of a sudden my mortgage can be, basically assumed by someone else. So my mortgage is at 3%. If it all of a sudden it's definitely going to become a full 30-year mortgage versus me paying it off early, you have destroyed the banking system. You have created massive losses for those investors of mortgage-backed securities. So, this can only be on loans going forward, which 30 years from now, that may be great. That system may work, but the impact of it will take so long before you have enough mortgages that matter. And now they're at high rates, so no one wants to assume any of these in theory.
Yeah, so help me just understand this real quick. And I don't want to rat hole on this, but let's say you've got, I buy your house from you today, and you're going to the nursing home, so you're not going to buy a new house. You don't want to take that mortgage with you, right? Now, presumably, you've got, I don't know, let's make this up, it was a 30-year mortgage. You now have 15 years left on it, right? So if I'm buying your house, why can't I assume your mortgage and then just take out a new mortgage for the remaining part of the purchase price that I need to afford?
Okay. So let's just look at my personal example. I refied in, I believe it was 2020, into a brand new 30-year mortgage at 3%. So it's 5 years old, approximately, right? The bank lent me money at 3%. Their current borrowing rate is 7% or
Hmm.
6%, 5%, whatever it is. They're losing money on my mortgage. Now they're saying, okay, we're only going to lose money on Mike's mortgage until he moves. Hopefully, he's coming up on retirement someday. I'm betting he moves when he's 65, which would be 8 years from now, right? So they only have to withstand that loss for 7 or 8 more years. But if it gets assumed, it's a 30-year mortgage. It's going to last 30 years. So they made a bad loan.
Oh,
They
got
don't
it.
want
So
to get stuck. It's the negative carry that they're getting
okay.
stuck
So,
with
so
for
they've got it
30
on their
years.
books assuming a shelf life of less than 30 years. And
Oh,
by making
much
them
less.
assumable, it extends that. Okay.
Right. Right. I mean, most mortgages, my bet are gone within 10 years.
Okay. Because
People
the person's
move,
moved and then took out a new mortgage.
they refinancing gets rid of the mortgage. There's
Yeah.
all kinds of ways mortgages go away. So you have just extended negative carry on financial institutions for 10, 20 years. We've talked about duration. Do the math on that, and it gets pretty ugly.
Okay. All right. Well, I like it for the consumer, but yeah,
I like your idea. Believe me, I think it's a great idea, but the banking lobby ain't gonna, well, you can't change it anyway. I have a contract with the bank. It says I can't give this mortgage to someone else. So,
got it. Meaning you're saying
no
the
matter what the
assumability would
laws
only
say,
be
they
on new
contract
mortgages.
laws on their side.
Got it. Okay. So you're saying if we ended up adopting assumability, it would just be on mortgages that are struck from now into the future. It wouldn't apply to past
And
ones.
right, and there's 6, 7% mortgages. Who wants to assume those?
Right. Right. Hopefully those will prove to be relatively high in the future.
Right.
All right. Well, look, as we wrap up here, I think we do have time for a quick rant before I get to it. Trades. Have you guys made any notable trades over the past week?
We have not done any trades, but we did introduce a new thematic portfolio, an energy model. I think Lance talked to you about it last week.
He did. So is that now live?
So it's live. If you go on SimpleVisor, you could see it. It better be up on our site where people can invest in it. I'm not 100. I know there was some email chatter right before I got on with you, but I think it is up. The models have been built in our systems. It's just a matter of being able to click on it within the website. So, but you can certainly see it. I'm actually looking at it now on SimpleVisor. It's actually having a great day. Energy must be doing well today.
Yeah. As I said
But
earlier,
it's up,
earlier today, it was oil and VIX were the only two things that were up. So
right?
sounds like that's
Looks
continued.
looks
All
like
right. Well, look.
oil
So
is
next
doing
week,
well.
then, whether it's you or Lance, I'd love to do a walk through that. I talked about that with Lance, and he said he wasn't sure when it was going to launch. He knew it was launching soon, but it sounds like it's now
Mhm.
officially out in the wild.
Right.
Okay,
Yep.
great.
It's
Yeah,
out there.
lot of
I'm staring
interest,
at it.
lot of interest in this audience about investing in energy, but even more specifically, sort of oil and gas, just given how beat up that sector has been, and thinking at some point in time for a whole bunch of different reasons that it could eventually uh, experience an upcycle again. TBD on when that's going to be, and maybe when we go through your model, we can talk about your guys' general outlook on the energy space. But super
Mhm.
interesting to now know that you've got a vehicle there for people who want to invest in a basket of stocks that you think are well positioned. They can go and find that important on SimpleVisor.
Correct.
All right. All right. So just in doing a quick rant here, Michael, you and I have talked about how we bond on a lot of the fitness stuff. So I just finished a couple days ago, I finished a 5-day fast. And
Oof.
yeah, yeah. And it's funny.
Just water?
It's a little bit, it's called a fast mimicking diet. So
The dirty fast.
it's scientifically engineered to get you into ketosis and then into autophagy, and it's all kind of designed to kind of like get your body into all the benefits of fasting, but you do
Mhm.
have some like thin soups and stuff along the way, so you're not having just water. And they give you some electrolytes so you don't, your system doesn't go out of whack or stuff like that. But very glad I did it. I do it ish about once a year or so, and I'll explain why in just a second. But first off, I think they should call it a slow because there's nothing I've done that makes time go by more slowly than being on a fast. And you realize how kind of addicted we are to eating, not for the calories to sustain, but so much of it's just habit and it's just something to do.
The ritual.
Yeah, the ritual, and it's just, it's a little pick me up, right? And when you remove that from your life and you're just sort of sitting around trying to find ways to occupy the time otherwise, like the clock moves real slow. So, anyways, first off, I thought, yeah, they really should rebrand it to call it a slow. Um, and look, I did it for a couple of benefits. One, I've kept folks generally updated on the strength training that I ramped up over the past year. And my trainer was really big on me eating for muscle gain, which is good, and it definitely resulted in some real performance gains. But it also got me up to a weight I just didn't love being at. And so I wanted just to trim a little bit of some of the padding. So, hey, that was good. Um, it's also really good for reducing inflammation. And I had injured my knee about a year ago, and putting on the weight wasn't helping, right? I think it's something like every pound of weight you put on, it's actually like your knee gets like 4 pounds of extra pressure on it. So giving my knee a little bit of relief, right, by getting rid of some weight, but also reducing the inflammation, which is what the thing that was just keeping my knee from healing. I have now on this side of the fast. I don't want to say it's been like 100% fixed, but I mean, I'm feeling like maybe like 85, 90% at this point, as long as I don't pack the weight back on again. So that was a nice benefit of this. But the reasons why, they say that, fasting is beneficial, I'll go through them in just a second. But it kind of makes sense, right? I mean, think back to kind of caveman days, right? You didn't catch a gazelle every day, right? So the human body is designed to go through periods where calories are not plentiful, right? And there are things that the body does during those periods that we've just our whole metabolism is evolved around, and we don't generally give ourselves that exposure anymore in the modern era because calories are plentiful, right? So there are health benefits you get. So when you aren't eating a lot of calories, and certainly when you aren't eating like simple sugars and carbs, your body will actually switch its metabolic pathway. It'll switch from burning sugar to burning fat. That's what fat is. It's a fuel storage, and it's designed to be used when you're not getting access to simple calories. And so that process is called getting into ketosis. And ketosis is good because it does give you appetite control. So a lot of the hunger pains you feel, those are pangs for the simple calories that we like. And when you're burning sugar, your body is saying, yeah, get me more of that stuff. And the hunger pains is a way to drive you to get more of that stuff. Once you're in ketosis and you're consuming your own fat stores, you don't really have those hunger pains anymore. It's really interesting. And going through these fasts, for me, the hardest part is like the end of day 2, sometimes beginning of day 3. That's when your old system is saying, no, just give me the really good, tasty, simple stuff, right? Once you get into ketosis, that goes away. And the rest of the days, while you're kind of thinking about food, your stomach isn't like driving you to rush to the pantry and get something. You get kind of in almost a sort of Zen state. So that's nice. It's a break from us to realize that we don't really need nearly as many calories as we think we do to function. We eat generally in such an unnecessary surplus. I'm not even talking about the quality of the food, just the quantity to just subsist as a human and still function. You really don't need nearly as many calories as the average, one of us eats on a daily basis. But obviously, when you get into ketosis, you're fat burning as well. So that's good for if you're trying to lose a little bit of weight. It's really good for blood sugar regulation. And it can even repair your body. Like if your body is getting compromised in processing sugar, like if you're diabetic or pre-diabetic, it's not a magic bullet, but it actually can kind of help your body be more efficient once you start eating sugar again, once you've gone through ketosis for a long enough time. It's good for neurological health. In fact, it's actually used, the diet is used to treat people with a whole variety of different neurological conditions. It's good for your heart, and it's good for mental clarity. And I got to say, that's what I experienced. It really does sort of sharpen your senses. And if we all talk about food torpor and kind of the brain fog that eating too much can bring on. Being in ketosis really helps get rid of that stuff. And I mentioned earlier, inflammation reduction. So those are the benefits of ketosis. And then when you're in ketosis long enough, your body goes through this process called autophagy. And autophagy basically is saying, look, I still have to run my metabolic processes, and I need ingredients to do that. I'm not eating anymore right now, so I need to start looking for ways to get those ingredients. And it's pulling some from fat, but it's also looking around your body. And what it does is it starts targeting your damaged cells or your old or your senescent cells. And it breaks them down, and then it uses those components to rebuild the new things that your body needs to function. And so it's kind of like a spring cleaning for your body. I don't want to say like it's something you can feel, like, oh, I feel like autophagy is scrubbing my arms right now. But you do feel better as the days go on. And they say that it's actually really helpful to kind of do this on some sort of periodic basis, just like an oil change, just kind of scrub out the system. So you get that benefit from doing it. Another benefit you get is you get way too much credit from other people. When I was I was posting on X every day my progress. I was just posting what the scale was reporting and just describing what I was going through. And people were like, "Oh my God, I can't believe you've been fasting for 3 days or 4 days." I could never do that. Yeah, you could. Your body is designed to do it. It's not the easiest thing in the world, but it is certainly not the hardest thing in the world either. But I won't lie. It's kind of nice having people treat you like you're curing cancer just for, not eating for a couple of days, right? So that's kind of fun. And then I guess the last thing I'd say here too is when I talk about, you realize how you don't need all the calories that we just shove down our throats every day. I'm reminded of that line from Raiders of the Lost Ark where Indiana Jones he's pretty beat up and he's sore, and his girlfriend says something about his age, and he says, it's not the age, sweetheart, it's the mileage, right? That's what a lot of health and fitness is about. It's not necessarily our age, it's what we're doing to our bodies. And if we're
Mhm.
putting repetitive stress on our systems or joints or whatever, right, that's what catches up with us. It's not so much
Right.
the age that's, on your birthday cake. And I do think we kind of overstress our digestive systems by eating a lot more every day than we really need to. And look, folks, it's not like I've come out of this fast and I've totally changed my entire life around it, but it's just made me more mindful of this stuff, right? And the hope there is just to put a little bit less stress on my system going forward, and hopefully that extends my longevity. So, anyways, folks, if you're thinking, I had a lot of people say, "Hey, you're inspiring me to think about doing this." If you I would totally recommend it. I would recommend following a program. I wouldn't recommend just like not eating and doing a water fast for X number of days if you've never done anything like this before. So if you want to follow the program that I did, it's a company called Prolon, and in fact, if you want to get 25, if you want to learn about them, but if you're interested, this link will get you 25% off the fast that I did. You can just go to thoughtfulmoney.com/Prolon. So anyways, that's my whole diatribe on fasting, Mike, but curious to hear your thoughts since I know you're a guy who takes his health real seriously.
Yeah, no, I've looked into it. Tim Ferriss talks about that occasionally. I've listened to him. Uh, I don't want to lose any more weight. So I'm, believe it or not, pre-diabetic. I'm skinny. I work out a lot.
Yeah, that
I eat
surprises
well.
me.
I just don't produce enough insulin, right? It's metabolic, I
It's
guess.
just
So
genetic.
I've been wearing a glucose monitor. My cardiologist said, try a glucose monitor for a few weeks, see what it is, see if there's something that's spiking it, that's causing it to stay elevated for long
Yeah.
periods. That may be the problem. So I've had this thing on for 2, 3 weeks now, and the problem with it is I'm way too analytical for this. And I'm always now I'm playing games. I'm trying to exactly identify everything, and it's I can never have this thing on forever. I can't wait to take it off because it makes me think way too much about everything I'm eating, when I'm eating, how I'm eating.
It
Am
makes
I
you
eating a
OCD, takes all
salad
the joy out of
before
eating.
dinner? Right. Yeah. So I've thought about the fast, and I used to do a like a 16-hour fast 3, 4
Hmm.
times a week, and I stopped doing that. I was just finding I wasn't getting enough protein. So now I do it. It's actually on my days with Lance when I do our podcast. I pretty much go from dinner the night before till about 1 or 2 in the afternoon the next day. And I do a 16, 17, 18-hour fast, whatever it is, once a week. But you know, I think about that all the time, Adam. I don't know.
Well,
It's
it sounds like in
daunting.
your case, and this goes for anybody with a health condition, obviously talk to your doctor then before you do something like a five, as long as a 5-day fast. Um, but that's interesting. There's a nutritionist. He's one of the more famous sort of nutritional influencers. Is a guy named Rob Wolf, um, and he was actually a co-developer of the paleo diet. Um, and when those monitors came out, so he's a big thing. He's a big focus on your insulin response to different foods and what impact that has on you. So Rob's been a big proponent of the keto diet, and so he kind of like Tim Ferriss, just wanted to analyze the stuff. And he realized after doing that, he said, wow, there's a lot of nutrition rules that apply to everybody. But he said, but then there's a whole bunch of personal idiosyncrasy that comes into play as well. And so he wore that same meter and had his wife wear it. And he said it was crazy. He said, we kind of have the same genetic backgrounds. I mean, we're I don't know, I believe both sort of like Western European descent type of thing. But he was like, there were certain foods I ate that would send this thing screaming through the roof that it wouldn't move at all for his wife, and vice versa. Yeah. So,
Right.
anyways, hopefully you've been finding some interesting things about like, and to him too, it was a lot of times it wasn't something that he thought that would spike his insulin. So I'm curious if you've had any foods where you're like, wow, I thought it was a safe food, but after I ate it, my system spiked.
I had pizza and a beer Wednesday night, and it had very little impact. Uh, I had Saturday night, so I've been testing this thing. I want to do all extremes.
Yep.
Saturday night we went out for Mexican food. It was delicious, but it was probably pretty bad, high in carbs, and a few beers. And it not only spiked it, which I knew it would, but it just stayed elevated a long period. So it's hard. I think what you really need to do is just have pizza. Then a few weeks later or later, have a salad and then eat your pizza. And you just have to do all these different experiments where you're separating out all these different food types and not just putting it all together because then you don't know what really is causing the spike. There's a guy that I saw on Facebook that basically he fasts and then he eats something,
Hmm.
chocolate bar, a bowl of quinoa, banana, whatever. And he measures it and he shows you exactly what it did. And what I see with him is it's not the same for me. There are things that had a big effect on him and don't really impact me and vice versa. Sleep matter, exercise. The days where I do a hard work my high intensity workout, the glucose stays lower than on days where I'm doing more of a aerobic type or even lifting. So it's
Interesting.
the type of workout too matters.
Wow, that's so interesting. Well, okay, so folks, the key takeaway here is, the good news is we live in an era where you got a lot of potential solutions available to you, and tools and things like that. But there's a fair amount of self-learning that needs to go on through all this. So it's kind of like, look, as I always say, one of the forms of true wealth is your health. Um, you know, invest in it. And the good news is you've got a lot of resources here that can help you, but you got to take advantage of them to benefit from them.
But don't let it drive you crazy like this thing is doing to me.
Yeah, yeah. Don't let it bring out your inner OCD, which it sounds like
Right,
yours is. Yeah.
right. It's still okay to have beer and pizza.
All right. Well, look, folks, if you think one of the best ways to improve your health, both physical and mental, is to continue to listen to Michael and Lance every week when they appear on this channel, please let them know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you'd like to get some guidance from a good professional financial advisor to help you prepare for the road ahead and what it might involve, particularly if it takes some of the twists and turns that Michael and I talked about that could potentially happen from here. If you don't already have a good professional advisor who is providing that advice to you, consider talking to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Maybe you'd like to talk to Mike and Lance themselves there at RAA. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These discussions are totally free. It's just a service these firms offer to help as many people as they possibly can. Michael, can't thank you enough. You did great pinching in for Lance this week. Again, really hope things are going as best as can be hoped for with his wife. But that doesn't mean, if they are, that doesn't mean we don't want to have you back on this program regularly going forward.
Absolutely, whenever you want.
All right. Thanks so much, buddy. Everybody
Yep.
else, thanks so much for watching.
Take care.